Typically, you're going to have mortgage insurance when your loan is seen as more risky to the lender. What that means is you could have less of a down payment, maybe less than the 20% equity that most lenders want. Or you could have had bankruptcy and you're having to go with an FHA loan. Maybe you're getting a down payment assistance program. There's a lot of different reasons that you could end up with mortgage insurance, but the main one is usually a low down payment. When you're paying mortgage insurance, there's a couple different ways that you can pay it, which I'll get into the different options for mortgage insurance, but usually with FHA, there's the upfront fee, and then that's a lot of times that's financed into your loan amount, or you could just pay all that upfront, and then you have a monthly mortgage insurance payment. 90% of the time it's paid with your regular mortgage payment. Sometimes you'll pay a separate company for the mortgage insurance, but really what that does is that's an insurance for the lender. So they're gonna go ahead and fund your loan, but if something happens and let's say you go into default and they have to foreclose on the home, then they get a payout from the mortgage insurance company for whatever it was under. Let's say the mortgage insurance covered 10% of the purchase price of the home, then they'll get that 10% back from the mortgage company. So there's all different ways that they set up their payouts, but basically it insures the lender. So you're paying that premium though. That's your PITI-MI. Aside from that, you're also gonna have HOA dues if it's a condo or you live in a community where they have a homeowners association. And that basically means that you're paying dues so that the homeowners association can maintain the common grounds. Let's say you have a pool that everyone has access to, or the outside landscaping. So those homeowners association dues are what's going to pay to have those things taken care of. The other thing that shows up a lot that people don't really look for a lot is what's called a Mello-Roos, which that's an assessment from the city, or it could be from the county. But basically those are taxes that you end up having to pay for if it's a new community to get the sewers, the streets, the electricity, all the plumbing, everything put in throughout that community. Or it could be maybe they're building a new school, right? Or they're redoing the roads. There's all kinds of different Mello-Roos and taxes that end up getting added to your tax bill. So the reason that I'm mentioning the PITI, MI, HOAs, Mello-Roos is all of that is going to determine what your actual monthly payments are on this property, or yearly payments, however you want to see it. If you're trying to qualify for a higher purchase price for a home, you may want to stay away from condos where they have an HOA. You may want to stay away from communities that have an HOA, because that $300-400 monthly fee, that's going to bring the amount that you can afford down. Same thing with Mello-Roos. If there's a Mello-Roos, that's going to be taken into consideration when you're qualifying for that new loan on that property. Also, it's extra fees you're going to have to continue to pay, and a lot of times HOA dues, I've never seen them go down. They're going to go up over the years. Same thing with Mello-Roos. Some of them are supposed to drop off after a certain amount of years. It could be 20 years before that extra tax or supplemental tax drops off. So always talk to your realtor about whether there's an HOA, if there's a Mello-Roos or a supplemental tax. If they can get a hold of the tax bill, then that'll give you a pretty good idea of what your total output's going to be, and the lender's going to need that anyway. But it's always good to know that before you get really excited about the house, just so you're not getting this unexpected $300-400 a month extra payment. That's not a really good surprise to get.